So here are the business terms for consideration. And I'm just giving you this advice now. Normally you'd have to speak to a lawyer, your accountant, as you go into more serious negotiations. So take this free advice, but it is important to follow up with a professional. All right, so the first thing is, when you go to an investor looking for capital, make sure you have some sort of confidentiality agreement in place. You can get these off the net, you can come and talk to me, I'll give you a template. It's a simple one-pager, it could be more. But even if it's your friend, just say, boy, I have this idea, but do you mind, can we sign a confidentiality agreement? You don't have to do it in all circumstances. These are just things for consideration. Valuation. This is the other one. So skin in the game is something where I walk away if someone does not have any skin in the game. Valuation is the other one that I walk away from. But I won't walk away immediately. We'll try to negotiate. But if there's a problem, it's no point me coming in if you think I'm paying too little for your business, because we have to work together for the next 5 to 7 years as partners. And it's no point you taking someone in if you think we're gouging you. What is valuation? Valuation is really an exercise trying to determine what's the market value of your business. And there are multiple ways to triangulate on valuation. Usually investors like when you look at what is the market value as opposed to the accounting value or the replacement value. And the best way to look at the market value, there are multiple ways, is to say what is the value of the future cash flows of this business, and you discount it back at some rate. We do it at what our minimum return rate would be, which is 20% for a well-run business, 25% for kind of a business that's starting up. So you can do that analysis yourself, come into the meeting knowing what you think the valuation should be. Security. Security means what sort of instrument are you looking for? In this room, we've talked about debt being hard to get if you have no collateral. So for the most part, it's going to be equity. But for equity, it can either be in common shares or you could do preference shares. Preference shares, the quick and dirty way to think of, or quick and easy way to think about it, is it's kind of like debt, but it's shares. So its preference shares will be at some rate, let's say 8% or so. And you just have to pay the investor back at 8% till you've determined what the whole period is, if you will. And that can be a bit easier on cash flows of the business versus senior debt. For common shares, you're usually not paying. There's no interim payment required. It's just equity in your business. And when you either sell the business or list the business on the junior stock exchange, the equity investor will get paid out at that time. But you do need to figure out what sort of security you're looking for, and you would need advice on that. But these are the things to consider. Covenants. Any investor is going to look for covenants. They're boilerplate language, particularly in this region. We have to make sure that you're not going to walk away with the cash, or steal cash, I guess. You're not going to make decisions that really should be more unanimous and in tandem with the investor. And so they'll be looking for covenants, and that will be part of the negotiation. So it's just something to be aware of. Again, I can't tell you all the details now, but it's something that should be on your radar screen when you're having initial negotiations with outside investors. Governance. Anyone who's giving you equity capital, they're going to be looking to at least have a seat on your board of directors. So newsflash, you should form a board. So there are people who come to us with family businesses and they have no board. I will say you need to form a board. So depending on, if you go to family and friends for capital, they probably don't care about whether you have a board. If you start going into the venture capital ecosystem that I was mentioning before, private equity, maybe even a high net worth individual, they may actually care about that. They're just looking to see how decisions get made, and they just want to be a part of that. That's really where it comes from. And the board of directors is really responsible for governing the company. Project costs we spoke about, so just being clear about how the funds will be used. And finally, the reporting and information requirements. So you should ask the investor what information you're going to require, how often. An example would be things like monthly unaudited financial statements. Maybe they want to look at monthly sales, maybe quarterly. But you just want to get that up front because that's more of your time and work that's different from how you did the business before you got the capital.